Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your resident tax planner and guide. Today we're choosing and implementing tax-advantaged retirement plans for your business and future. We'll simplify options, highlight tax savings, and share case studies so you keep more, save smarter, and build wealth without tripping compliance wires. Retirement plans are tax machines. Pre-tax contributions create deductions now, tax deferral on growth, and taxable withdrawals later, usually at lower brackets. Roth contributions skip deductions, but deliver tax-free growth and tax-free qualified withdrawals. Many combine both, smoothing lifetime taxes. Employer contributions are deductible to the business, compounding savings and flexibility. Start with structure and goals. Solo owner with no employees, favor IRA, SEP, or solo 401k. Small team seeking simplicity, simple or safe harbor 401k. Growing business wanting retention and owner funding, safe harbor 401k plus profit sharing, maybe cash balance. Consider cash flow, age, income volatility, and admin appetite. Traditional and Roth IRAs are foundational. Contribution limits are modest, but costs and admin are minimal. Traditional contributions may be deductible, subject to income and workplace coverage limits. Growth is tax-deferred. Roth contributions aren't deductible, but qualified withdrawals are tax-free. Both allow broad investment menus and straightforward, low-friction startup timelines. CP IRAs fit solos and businesses with uneven profits. Employer-only contributions, up to 25% of W-2 wages or 20% of self-employment income, within 415C limits. Easy setup and funding flexibility. Pitfall: the same percentage must go to eligible employees, which can become expensive and limit owner contributions as staff grows. Simple IRAs are starter plans for up to 100 employee businesses. Employees defer pre-tax or Roth under Secure 2.0, and employers either match up to 3% or give 2% non-elective contributions. Low admin, but lower limits than 401ks and mandatory employer funding. 2-year rollover rule and early distribution penalties deserve attention. Solo 401ks shine for owner-only businesses, allowing employee deferrals plus employer profit sharing, highest flexibility, Roth deferrals, and potential plan loans. Spousal employees can double impact. Admin is manageable. Form 5500 EZ begins at $250,000 assets. Pitfalls: missed establishment deadlines for deferrals and forgetting separate W-2 versus self-employment income calculations rules. Employer plans expand options and retention. Core flavors: traditional 401k, safe harbor 401k, 401k with profit sharing and defined benefit or cash balance. As teams grow, designs must balance owner goals, fairness, costs, and testing. Payroll integration, eligibility, and education become critical to drive participation and pass compliance checks annually. Traditional 401ks support pre-tax and Roth deferrals, optional matching, and profit sharing. They require non-discrimination testing, which can constrain owner deferrals if rank and file participation is weak. Good fits for engaged teams or when you'll use automatic enrollment and strong education. Flexible, scalable, and compatible with advanced allocations and vesting schedules. Safe Harbor 401ks bypass ADP-ACP testing by committing to prescribed employer contributions. Common designs: basic match, enhanced match, or 3% non-elective to all eligible participants. Result: owners can generally max deferrals regardless of staff participation. Combine with profit sharing to push more tax-deductible dollars to owners while rewarding employees meaningfully. Profit sharing adds employer dollars with flexibility. New comparability and age-weighted formulas legally skew allocations toward owners and older employees within testing rules. Vesting schedules aid retention. Coordinated properly, a safe harbor match plus profit sharing can deliver near maximum annual additions for owners, while keeping staff costs predictable and defensible. Cash balance plans are defined benefit plans with account-like statements. They allow large deductible contributions, especially attractive for high earners age 45 plus. Contributions depend on age, compensation, and funding assumptions, requiring an actuary and annual filings. Layer with a 401k to supercharge savings while controlling staff costs through coordinated designs. Roth shines when today's bracket is lower than expected retirement brackets, or when tax diversification adds flexibility. Younger entrepreneurs, temporarily low-income years, big deductions elsewhere, or legacy goals often favor Roth. In employer plans, Roth deferrals don't reduce payroll taxes, but qualified withdrawals are tax-free, shielding growth from rising rates. High earners can use the backdoor Roth. Make a non-deductible IRA contribution, then convert. Beware the pro rata rule. Existing pre-tax IRA balances make conversions mostly taxable. Solutions include rolling pre-tax IRA funds into a 401k first. Accurate Form 8606 reporting is essential to preserve basis and avoid double taxation and errors. Secure 2.0 supercharged adoption. Startup plans may receive tax credits covering administrative costs and employer contributions subject to caps. Simple and SEP can now offer Roth. Long-term part-time workers must be allowed to defer after meeting hour thresholds. Expect automatic enrollment and escalation, boosting participation, testing results, and retirement readiness. For S corporations, only W-2 wages count for deferral and employer contribution formulas. Distributions don't. Reasonable compensation is critical. C Corp are similar. Sole proprietors and partnerships use net earnings from self-employment after adjustments. Planning payroll levels strategically can unlock higher contributions, better deductions, and Social Security and Medicare credits. Know the limits. Employee elective deferrals cap under 402G. Total annual additions to a participant's account cap under 415C. Across employer contributions and deferrals, catch-ups at age 50 plus increase room. If you work for multiple employers, 415C per plan sponsor applies, but 402G is shared. Track carefully to avoid penalties. Deadlines matter. Employee deferrals must be elected before pay and deposited promptly. Solo 401ks generally must be established by year-end to allow deferrals. Employer contributions to SEP, 401k, and cash balance plans can be made by the tax return due date, including extensions. Document elections and keep payroll evidence organized. Non-discrimination tests, ADP, ACP, and coverage. Compare benefits between highly compensated and non-highly compensated employees. Top-heavy rules can trigger minimum contributions if owners dominate balances. Safe harbor designs avoid ADP, ACP testing, and top-heavy minimums. Good payroll data, eligibility tracking, and timely notices prevent failures, corrective distributions, excise taxes, and very unhappy employees. Plans require attention. You'll coordinate a record keeper, third-party administrator, custodian, and payroll. Someone serves as plan administrator and fiduciary, monitoring investments and fees. Consider 316 administrative fiduciaries and 338 investment managers to offload duties. Budget for setup, per participant, and compliance costs. Periodic benchmarking can reduce fees and improve outcomes materially. Many 401ks allow loans, typically up to 50% of vested balances, repaid via payroll. Hardship and emergency withdrawals exist, but taxes and penalties may apply. Early withdrawals before 5912 usually trigger 10% penalties. ERISA plans provide strong creditor protection, often shielding assets from lawsuits and bankruptcy, a valuable risk management feature. Required minimum distributions start at age 73 for most, later moving to 75. Roth IRAs have no lifetime RMDs. Roth 401k. RMDs were eliminated starting 2024. Rolling Roth 401k. Money to a Roth IRA simplifies. Keep beneficiary designations current. Post-death rules are stricter. Review stretch options, 5-year rules and taxes. Health savings accounts offer a triple tax advantage: deductible or pre-tax contributions, tax-deferred growth, and tax-free withdrawals for qualified medical expenses. After age 65, non-medical withdrawals are taxed like IRAs without penalties. Invest balances, pay current costs from cash, and save receipts for future reimbursements. They complement retirement plans beautifully. When selling or closing, address the plan early. Options include terminating the plan, merging into a buyer's plan, or allowing rollovers to IRAs or new employer plans. Communicate timelines, finalize contributions, pass testing, and file final 5500s. Entity changes can reset coverage groups, affecting eligibility, testing, and design choices materially. A solo consultant earns $180,000 with variable income. S&P allows 20% employer contributions, but no employee deferrals or Roth. Solo 401k enables $23,000 deferral, $3,500 age 50 plus, Roth option, plus profit sharing to the 415c limit. Result: higher potential savings, better timing control, and future backdoor Roth flexibility and portability. A 5-employee dental practice struggles with testing. We implement a safe harbor 401k with a 3% non-elective automatic enrollment at 6% and targeted education. Add new comparability profit sharing favoring owners and longer tenure staff. Outcome: owners maximize deferrals, receive large deductible allocations, employees gain meaningful benefits, and testing hassles vanish. A 55-year-old owner nets $900,000 with few employees. We pair a safe harbor 401k plus profit sharing with a cash balance plan. Actuarial targets permit 6-figure deductions annually, accelerating retirement funding. Staff costs remain affordable via age-weighted allocations. The plan doubles as a credible tax shelter by meeting strict compliance. Common mistakes: setting plans too late for employee deferrals, misunderstanding eligibility, misclassifying workers, ignoring top-heavy status, missing catch-up contributions, and failing to coordinate multiple plans. DIY errors include botched payroll integrations, poor notices, and missing Form 5500s. Penalties and corrections often exceed professional fees, plus opportunity cost from lost deductions annually. Action plan: define goals and cash flow. Choose a plan that fits your team and complexity tolerance. Confirm eligibility and deadlines. Implement with aligned payroll and providers, and review annually. A preparer and planner aligns tax strategy, plan design, and compliance, helping you maximize deductions, avoid traps, and stay confident. That's tour of tax advantage retirement plans. You learned how to match designs to business stages, when Roth wins, how safe harbor, profit sharing, and cash balance unlock deductions, and which deadlines matter. I'm David Robson. Subscribe, share, and send questions. Until next time, keep more, worry less, and plan smarter.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.